All right, well, as we mentioned, global markets experiencing a what you might call a rush to safety. Maybe you could call it a tempered rush to safety after Israeli airstrikes on Iranian nuclear targets, which has prompted investors to put money into gold and to oil, which is surging this morning. WTI is north of $74 in New York, but it has left the stock futures in the U.S. under some pressure. Investors basically playing defense, if you will, this morning. But what is unknown is, with these attacks, how things play out from here and how the market will ultimately position over the coming weeks. Let's bring in Earl Davis. He's head of fixed income and money markets at BMO Global Asset Management and one of our regular guests. Earl, it's great to see you. I think what was interesting about this story, just sort of with Israel's big move here, there have been targeted killings and attacks in the past, but never anything quite like this that would directly go after nuclear facilities. And I think the reason for that probably is because you don't know what's going to come on the other side of that. And now we're going to have to figure out what does come on the other side of that.
Yeah, that's definitely correct. And I love the way you phrased it before, tempered risk off. And the reason why it's tempered right now, the market's in between, or asking the question, what will be the persistence of this? How long will this conflict last? And right now you're getting mixed messages depending on which markets you're looking at. If you look at the oil market at all-time highs right now at this moment, not all-time highs, recent highs or the highs of the day, right time at this moment, it's saying this could be persistent. But as you said, with equities, when you look at equities coming off the lows of the overnight session, it's tempered. So there's questions as to the persistence of this, but it definitely complicates central bank functions.
Now, we'll continue to listen to what we hear out of the White House. Looks like Israeli Prime Minister Benjamin Netanyahu's hitting the phones. He's expected to speak with Donald Trump. He's also expected to speak with Vladimir Putin, the Prime Minister from Britain. And it looks like he already spoke with the leaders of Germany, France, and India. So there are dialogues taking place here after Israel decided to make this move. I guess, is going back to the idea of a market that is selling off but also waiting and seeing, the fact that we just got off like what felt like the trade tension stories, like avoiding the worst of the trade tensions, which had been one of the biggest storylines for months this year. And then it started to feel like we were moving into sort of a more orderly place. This sort of brings some disorder globally, and people just have to sort of react to that over time. Maybe they're not in the same kind of selling mood they might have been if we were still in the middle of a massive global trade war to the same extent.
Yeah, but I'll kind of recharacterize what you said, nuance it a bit. I think the market after Liberation Day, where we had major sell-offs in all risk assets, and then once Trump kind of stood back, said, let's wait till July, let's look. The market said, we have passed peak uncertainty. It felt more comfortable investing given that the levels at the time, not now, were good. What this conflict does, we have to re-ask the question whether we have hit peak uncertainty. So it brings back uncertainty into the markets. Our approach to these markets is, given where we are, we're getting a bit more defensive. We still like the markets and risk assets because there's so much money on the cash line, on the cash sidelines that could come in to support this market. So some people are looking at this as an opportunity while others are getting a bit more conservative.
Let's also, if we can, just show, we were showing gold and oil earlier. We mentioned that both are higher today. The fact that gold is up about 1.5%, but oil is up more than 8%, I think is also just a reflection of where these markets are. Oil has been arguably under-owned this year, and gold has been one of the star performers of the year as well. So, tempered on the selling, but also it seems like tempered on the buying, depending on which assets have really surged and which ones maybe were lagging.
That is correct. And I also think it, as you said with gold, look at us new highs. It does point to the importance of having this as a diversifier. It is a true flight to quality asset, which is what we're seeing today. The rally in oil is obviously not a flight to quality response. It's the supply-demand response in regards to the supply of oil and where the conflict is originating. So two different drivers today. Both could possibly be persistent, but I think it just points to the importance of a diversified portfolio.
Now, just to let our audience know, it looks like airline stocks are under some pressure today, and I was mentioning that that Bitcoin is lower. It looks like we'll likely see some of the tech stocks that really found their groove again after we got through what felt like the worst of Liberation Day. I would imagine that the calculation for investors is. For a market that has really roared back, what are the kinds of determining factors that stop a market like that? I mean, even if you're thinking about being more defensive, let's face it, people who were thinking about being defensive in the early days of the trade war are now kind of looking at what happened to the market and maybe kicking themselves over that, really.
Well, there's two things you have to look at as an investor in regards to your question. What stops a market? The thing that stops a market is uncertainty. And the reason why uncertainty stops a market is because people can't value the future price because they don't know what the future world will look like. Having said that, there are some core elements that are supportive of the market. What is a central bank reaction function? What is the reaction function of the world? So there are certain things here, and you always have to look at, I always say this to people, what is the wall of money doing? And as you saw, the wall of money was starting to come back into risk assets. So that doesn't stop on a dime. So I do expect this to be a controlled sort of retracement of a rally, but there's still opportunity here going forward.
Just a real quick question to sort of tie back, it's so early and it's hard to make economic conclusions on any of this, especially for what does it mean for Canada? And higher oil prices obviously is likely going to fuel the TSX to a new all-time high today. That would not be a surprise because it helps the energy stocks. But if the conflict persists and oil prices stay elevated or keep climbing, how does a higher or a much higher oil price complicate the economic picture, would you say?
Yeah, what's interesting, and it is a complicated sort of asset class because it complicates it on two fronts. One is on inflation and the other is on growth. And this is what central bankers are trying to figure out. On inflation, it's very obvious this has a direct impact on gas prices. Gas goes out, it's a huge component or spending component of the individual. So we will see CPI go higher based off of this, based off of higher oil. It's basically a 25% rally in the past month, which is significant. So we will see that flow through. So that complicates the central bank's reaction function because one of their mandates is controlled inflation. So if you see inflation going higher, it's going to be harder for them to ease. So it would reduce our expectation of eases going forward. So that's the growth, the inflation aspect. The other aspect's growth. Higher oils, even though it's inflationary, it's a tax on consumption. You spend $1 more on gas means you spend $1 less in the economy, in the real economy. So what happens and how do you balance that? And trying to figure out where that ends up will help direct the investment philosophy and approach going forward.